Talk to you a bit about our bowsprit project. Before I came on board, Sun was interested in the Eagle Vine assets. Those assets didn't work very well when the oil price downturn came. So a couple of years ago when I joined Sun, we set about restructuring, restarting again. We dropped those old assets and we looked for something completely new to do. At the time when we were looking for an asset, the oil price was around $40 a barrel, and we looked for something that would work very well at $40 a barrel. So talking to what Martin was speaking about earlier, we need something in a good jurisdiction, something that's going to make money at low oil prices and make a lot of money when the oil price recovered. So we made a strategic shift to position ourselves in a neglected portion of the Gulf of Mexico with our partner Pinnacle Energy. We've secured an interest over our initial field, which we named the Bowsprit Field. We have 50% in operatorship. It is around 1,100 acres, about just over 4.5 square kilometers, and it's located 70 kilometers southeast of New Orleans in about 10 feet of water. So why did we select this asset? The lease and the field overlies a field that was discovered by Shell in 1955 and was a large gas accumulation. Shell discovered a field there that had a 450-foot gas column and was readily developable with vertical wells back in the 1960s. Every time they drilled the field there, they encountered shallower oil sands in oil horizons, and those were relatively modest in thickness at the time. They weren't commercial to develop, but nevertheless they were flowed. So a few of the 4 wells were produced from the 7400 sand that we're interested in. They started production around 200 barrels a day and then tapered off to about 40 barrels a day. Our plan is pretty simple. We're going to go back to that field and we're going to put horizontal wells in. The minimum economic field size in this area, we believe, with one well is as little as 500,000 barrels, and our base case is around 2.5 million barrels recoverable, with potentially double that in an upside scenario. We took our project to risk, and I'll come on to the resources that they gave us in a bit. But the most exciting thing from my point of view was that when RISC did a bit of modeling on the horizontal well, they estimate that the initial production from a new well should be about 2,000 barrels a day with a recovery of 670,000 barrels within a space of about 3 years. The cost for that horizontal well is about $3.5 million US, and we're planning to drill that first appraisal well in the first quarter of 2019. A little bit about our capital structure. We have 756 million shares on issue. A number of options out there to do with the restarting the company essentially from scratch. Our share price this morning was 0.3 of a cent, but I think at 3.5 million, 3 million market cap, we've got plenty of upside. Our major shareholders consist particularly of one major shareholder, Fastlane, David Neat. David Neat's a high net worth out of Melbourne. He made a lot of money out of the deal that was done when, I've forgotten the name, the Aurora acquired the company they were interested in the Eagleford. He made a fortune out of that. Ian was the chairman at that time, Bill was the managing director, and he's put his money into backing the same team again, and I've been the one that's selected to do all the hard work. We have a legacy convertible note for $1 million with Hancock Prospecting, but they've agreed that we can repay that out of future production. So why did we select this area? That area of within the red oval there, we're in the Breton Sound area, which is this bit here. Our project is up in there. The area within that red oval has produced a couple of billion barrels of oil historically. Its heyday was back in the 60s and 70s, and but we believe there's still plenty of oil left there for companies of our sort of size. A bit more about the Bowsprit field. As I said, the main target sand is at 7400. It produced for a small pit for a period from 1960 to 1969. We have the production records from that time. It wasn't particularly exciting, but the 50-odd thousand barrels of oil that they recovered from that sand is 50,000 barrels out of what is about 5 to 15 million barrels in place, and so there's plenty of oil left for us to develop. We're bringing horizontal drilling to an established hydrocarbon province. Most of this area was abandoned and walked away from back in the late 80s. It hasn't had much horizontal drilling. One company that did drill a horizontal well in a project to the south of us, they drilled a 750-foot horizontal well into an old field that's still on production since it was put on in 1954. That 750-foot horizontal well tested at 1,500 barrels a day, came on production at 900 barrels a day, produced very well for a few months before watering out, which was to be expected in the field it was in. Risk modelled the well at 2,000 barrels a day, and so I'm very hopeful that this is going to be a readily producible field at commercial rates. When we took the project to Risk, they did have a look at it, and there's two sort of challenges that we face. All of the drilling that was done in the field was essentially done in the 60s. We're working with a very old data set and slightly incomplete. Risk's interpretation was that we've got two essential areas to the field. We've got this part of the field, which is the bit that was flowed, and they're quite comfortable that that contains movable oil and has flowed pretty well. The rest of it is implied because it's a very shallow sort of section here that sits underneath the wells that were at the bottom of the wells that were flowed. The reason that we believe that wasn't flowed was it was a few feet of oil that was sitting on top of water. If you perforate a vertical well with a few perforations, it's just going to water out very quickly, kill your well. When we acquired the 3D seismic over the field, it shows that there's a fault to the northwest of us in here, and it looks like the structure closes against a shale there, and that implied that we've got probably oil in that whole structure. Now, Risk has acknowledged that there's a wiggle on the resistivity curve. They're not completely convinced it's movable oil. I'm going to convince them once we drill a well in the first quarter next year. My model is that we're actually probably all connected sands. This is sand and shale, but only a well is going to tell which one is correct. So we're in the process of building a 3D geological model. The plan is to select a well location and then drill, and I'll come on to why. So basically, we've got two areas to the field. We've got the proven flowed area, and then we've got the bit that's up-dip potential. So what I'm looking to do is put a well in about here, prove that the up-dip potential exists, pull back, and then put a horizontal well across here, and that will allow us to prove that we can flow commercially viable rates. Building the model at the moment. Once we select the well location, which I expect to be in the next 2 or 3 weeks, we'll commence permitting. It's a 12-week process in Louisiana. That should have us permitted by the end of December and ready to drill in the first quarter of 2019. So this is the official resource summary that Risk gave us. We had very robust discussions, but they stood their ground. And they gave us, in the proven flowed area, they gave us contingent resources, which are contingent on us drilling that horizontal well and proving that rates are going to be commercially viable, and then recovering oil from the lower zone to prove that we've actually got movable oil there and it's not just some resistivity anomaly that could be explained by something else. I was hoping they were going to give us reserves in the top bit and contingent resources in the bottom bit, but they stood their ground, and I will move on. Basically, when you look at the oil in place numbers that Risk estimated for the whole structure, we have the leases over the crest of the structure. Risk assessed the volumes associated with the whole structure. In the main bit that's flowed, they gave us 5 million barrels in place. In the bit that's not been flowed, in the mid case, we're looking at 12 million barrels there, giving us about 17 million barrels in the most likely case. That's a good, reasonable target. I should be hoping to get somewhere between 15 and 30% of that, giving us a range of resources, if it is in fact there, somewhere between 2 and 5 million barrels. So we looked at the conceptual development plan. This helps us in terms of looking at what we're going to do to appraise the field, how we bet what the uncertainties are that we need to address. I looked at the individual well forecasting. We've assumed a modest 2.5 million barrels of recoverable oil, see what the economics look like on that. We've appointed Fence2Maker, who are the preeminent environmental consultants in Louisiana, to survey and permit the well location as soon as it's selected. And then we're using a group called Brammer Engineering, who are the local team on the ground. They're a one-stop shop. They do everything that we need, drilling and installation of production facilities and field operating. So looking at this, what drew us to this area is it is particularly cheap. 5 wells will cost us, oops, go back a bit. 5 wells will cost us in the order of $15 million US dollars. Unmanned production facilities can be put in for 4.5. 2 export pipelines laid, one at 1.6 miles to the nearest tying point is as little as 600,000, and operating costs should be pretty much fixed about $1.5 to $1.8 million per year. We have a state royalty payable of 21%, and then the severance tax after cost recovery of the drilling. So that gives us a pretty robust set of economics. If we only get about 1 million barrels of oil out of this, we're still making a comfortable 15 million, depending on the exchange rate that you assume. If we get the 2.5 million barrel, 3 million barrels, we're looking at $40 million net to us, $50 million if it's $70 a barrel. If we've got $100 barrel oil, we're looking at 82 million. If we've actually got 4 or 5 million barrels of oil, this is a $100 million project, and that's what we like about it. So what are we going to do? We're going to use one of the shallow draft barge rigs, take that out in first quarter of next year, drill our appraisal well, flow test it, assuming everything goes according to plan. We're going to suspend the well with a protection cage around it, finish off the design of the facilities, come out, install pretty simple, straightforward facilities that are going to look something like this, come back, drill a second development well, and put it on production. And if that all goes according to plan, that could be on by the end of 2019. So the bowsprit is our first project. The bowsprit on the boat is the bit that sticks out the front. The mother load's coming behind. So we're going to put bowsprit on production. That's our key priority at the moment. Then we're going to be, we see a number of follow-up opportunities in the area. We're going to be working up those to bid on that open acreage, acquire projects 2, 3, and 4. And then we see the potential to use new cable-less geophones and acquire 3D seismic to identify further projects in the area. In summary, we're 50% holder, operator of a high capex, low capex, high margin oil appraisal project with a value potentially to us of about 40 to 50 million at current oil prices. We seek to deliver project value in the order of 3 cents per share on a diluted basis after raising the funds to do it. And that's about a 7-fold or 8 or 10-fold increase to where we are at the moment. So I'm talking 10-bagger. We've decided that instead of farming out, which would be, the first well is going to cost us about $4.5 million gross to drill in Aussie dollar terms. Even on a 2-for-1 basis, it's not worth farming that out. It just doesn't make economic sense. We give up half of the value of the project. Our major shareholders are supportive of us raising the money, and I was hoping that we could delay the conference until next week when I could have been able to talk a bit more firmly about my plans and how that would have been done, but they wouldn't move the conference for me. So, as I see it, we're moving into a phase, we're going to be fully funded for the drilling very shortly. We've got some momentum building. We're going to be moving towards a market cap of 10 million, which will get us a bit more interest, re-ratable. We're coming forward. The well location is shortly to be picked, site permitted, rig selected, and we'll be drilling in Q1 of 2019. Thank you very much.